Hello, everyone. Glad you could join us for the Stock Market Jobber top 5 charts of the day. Now, there's some interesting stuff going on. And when interesting stuff goes on, what does that mean? Well, that means traders can make profits because as traders, we want things to move. When things are not moving, when things are very boring, well, that's when we go on vacation. That's when we go to the beach or walk our dogs in the woods or whatever your boring thing is. But when markets are about to move, that's when we need to pay attention. Now, if unless you've been under a rock, or maybe even if you have been, depending on what that rock is, you know that the financial sector has been in a big sell-off. And a lot of this has to do, well, as a matter of fact, all of it has to do with the fact that the banking industry, which is part of the financial sector, is in this massive sell-off. And I think things are going to get worse. I've been reading a lot of research, and there's a lot of other banks that have the same issues that Silicon Valley Bank did or does. But you know what? I can be wrong. The pundits can be wrong. The people that I've read about can be wrong. But you know what's never wrong is the market. So we have to let the market tell us what to do. The best traders are agnostic, and they let the market tell them what to do. Now, here we have the financial sector ETF, okay, XLF. There's 11 sectors in the S&P 500, and we follow SPY, which is the ETF that tracks the S&P 500. But we also follow at stockmarketjobber.com, and this is why you need to sign up and subscribe and give us some likes, because if you understand what's going on in the sectors, it gives you a lot of insight into what can happen within the SPY. So if you're trading SPY, you should pay attention to what's going on in the sectors. If you're trading the sectors, you should pay what's going on in the industries. But we're not going to get to that tonight. We just want to have a view here of the SPY and the sectors and what we're calling the flight to safety. So the financial meltdown continues. This ETF tracks the financial sector, yada yada yada, just going lower. We had a little day up here. For some strange reason, people thought that it was over. I'm not so sure that's the case. This was probably just some short covering. But regardless, on Friday, we kept moving lower. Now, get down to 2970. There's a good chance there's support. We have a bounce because it was support back here. A lot of times, levels that were support in the past can become support again. This is market memory. There's probably a lot of buyers back here who didn't fill their orders. They didn't buy enough, but you know what? They're like, all right, well, I don't care. I'm just going to be patient and wait. I'm not going to chase it. If it gets back to my price level, I'm going to buy it. So we see this a lot in markets where a level that was support becomes support again. So just something to look at. Now, if we get to the support and we don't bounce and we break down, well, it'll tell us that the buyers who created the support or the investors who created the support with their buy orders have left the market. And anytime you take demand or buyers out of a market, it could set the stage for a further move lower. So we got to pay attention to that. Now let's look at the banking industry, which is part of the financial sector. This ETF, KBE, tracks the banks. This is also a spider, but it's not the spiders are the S&P 500 depository receipts. State Street Bank, which is way up in Boston, has created this thing. They monitor them, they trade them. So that's what a spider is. Now there are other ETF families which are just as good, but just out of habit, I track these. So anyway, this is why we're looking at this. But this ETF tracks the banking industry. Resistance here became support here. Now, how could a level that was resistance kind of miraculously turn into support 3 years later? Well, levels that are important can stay intact for a long time, or they can retain their importance for a long time. Levels that were resistance can become support. This happens because investors who sold, some of them regret doing so when the price moved higher, and they tell themselves, I made a mistake. I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price I sold them at. So even though it's 3 years later, the market has a memory, and there are remorseful sellers who place their buy orders around 35. And over the last week, this is where we found support. Now, this is where I'm saying that this is going to be kind of an easy trade because we're at a really clearly defined level. And when financial markets get to really clearly defined levels, they tend to make moves. They tend not to chill at them for too long. And we've been here for 3 or 4 days, so we're either probably going to make I mean, I can't guarantee, but I think we're either going to make some kind of a tradable rebound or a breakdown. So something to watch. Now, the money that's been going out of financials has been going into other things. That's what we call the flight to safety. So if your financial stocks, your banking stocks are blowing up, and I don't mean you, I just mean the general public, if financials are breaking down, they start to think, oh, gee, I'm going to sell my financial stocks. Where should I put my money? What's been safe? Oh, gee, Apple and Microsoft have been safe. And that's true. So let's go take a look at them. Now, here's the issue with Apple. It's at resistance, right? Resistance around 155. Now, when things get to resistance, again, it's an important level. They can break through or they can go lower. Odds are probably against them hanging out for too long. Notice back here we got to resistance. We sold right off. Here, after about 2 weeks, we sold off. Here, we sold off. Why does this happen? Well, resistance is a large group of investors who are looking to sell their shares at or close to the same level. In this case, it's 155. When a market gets there, some of these investors start to think like, oh, gee, there are other sellers around. That's why the price isn't going any higher. And they start to get worried. They start to think they're not going to be able to sell their shares. Maybe they wanted to sell at 155, but they see other sellers come into the market and they think, you know what, I got to reduce my price. I won't get 155, but at least I won't miss it. So I'm going to go down to 154. Someone else sees that person go to 154 and they're like, I'm going to go down to 153 and so forth and so on. And you create this snowball effect. So that could happen here. But again, this flight to safety is going into tech, and Apple is the biggest part of tech. And we're at a crucial vantage point here. The next thing we got to look at is Microsoft. This is the other biggest part of tech. Between Microsoft and Apple, that's about 12 or 13% of the S&P 500. The S&P 500 is 500 stocks, and these two stocks are juggernauts. They're about an eighth of the entire benchmark. But anyway, we see we're overbought. This here is what we call the relative strength indicator. It measures momentum. Momentum is a measurement of how far something has moved from time point A to time point B. And if it exceeds what is its typical or historical trading range, we call it overbought. Now, this is important because things that are overbought tend to reverse. They tend to revert back to the mean. Things that are oversold tend to revert back to the mean too, but we're not talking about that now. We'll talk about that in a few months when the market gets to the bottom. But we had resistance here. We have resistance here. Why would a level that's resistance become resistance again? Well, there are investors who bought up here who regretted doing so. As a matter of fact, they're ashamed after the market goes down, and they tell themselves, I made a big mistake. If I can get out at break even, I'm going to. Once again, charts are telling us about psychology. So we have these remorseful buyers here placing sell orders. We're overbought. We're at resistance. To me, this looks overextended. So we see financials are still really weak. There's a chance this flight to safety unwinds. And the last thing I want to look at tonight is the 10-year Treasury bond. Now, look at this. This is the ultimate flight to safety, going into bonds, because bonds are considered really safe, especially Treasury bonds. I mean, I don't know how much longer they will be going into the future, considering how much debt we have. This red line here is their upper Bollinger Band. Now, this is a different way than the RSI of measuring momentum. This red line is 2 standard deviations above the 20-day moving average. Most trading, or what statistics tell us, is 95% of trading should be within 2 standard deviations of the mean. So if we get above that, there's a good chance that we get a reversion. Investors or traders will be expecting a reversion to the mean, and they're going to come in and sell. So we got above it there. It didn't really work out there. Got above it there, sell off here, sell off here, sell off. So once again, we're above this Bollinger Band. So we're overbought. We're at a level that was resistance. Levels that were resistance can stay intact for a while. And it's a principle of financial markets that we talk about at stockmarketjobber.com pretty much every day. So that overbought markets that get to resistance tend to sell off. So that's what we're going to watch this week, everybody. Please make sure you check back. Please make sure you sign up for Stock Market Jobber YouTube page. It's going to be a really interesting week. We got the Fed on Tuesday and Wednesday. Could be some big moves here. My guess is this whole flight to safety thing unwinds and we go lower. But you know what? I could be wrong. So check back and see if I am. Thank you, everybody. I will talk to you soon.